So, in this episode, we're going to be breaking down the big, beautiful bill, what it means for real estate investing, and why one key change, the removal of the revenge tax, is a massive, massive win for Canadian real estate investors. John, it's great to be here with you.
So good to be here, Mark. There was a lot of like unease, right, in the United States and Canada with this big, beautiful bill. And, it was really down to the wire. I mean, it was interesting, right? Trump sent this July 4th deadline. It was in with the Senate, I think, until like July 2nd. And a lot changed. In fact, the Senate is who removed this revenge tax. Now, that was a great example of Trump's negotiation style, right? Canada had implemented that digital services tax, and that was going to hurt American companies. And so, Trump, he has an aggressive negotiation style. Let's just put it that way, to say the least, right? And so I think Canada made the right decision pulling back on that, and that gave the Senate exactly what they needed to strip that out. So there was like this 24-hour period, Mark, where I was like, House, don't put it back in, don't put it back in, and they did, and so it passed on the 4th clean, and removing that is so huge. Not just for our Canadian investors, but candidly for American companies. A lot of our dollars come in from foreign investment, right? And so, it was a negotiation play, right? Trump's trying to work through these tariffs, and so he wanted to put that in to send, I guess, put a little fear. And like it or not, that's his negotiation style. So I couldn't be more happy to see the bill in its final state, and the impact it'll have on commercial real estate will be substantial. I think making it even better investment than it's ever been in the past. And as listeners of this podcast know, we think this is one of the best investments you can invest in. It's gotten even better. So I'm really anxious and excited to dive in today.
Yeah, for 100%. It was interesting when that revenge tax was rolled out, or I guess was proposed and going through the House and the Senate. I'd reached out to our accountant and I said, okay, hey, listen. And, I was looking into if everything does go through, how will that impact our investors? And we'll talk a little bit more about what was proposed. But it was interesting what he said. He said, Mark, over the last few months, he has one client that the tariff changes have changed 5 times. So he said, what's really interesting is, follow the money is what he said to me. And he said, the Canadian pension fund has over 50% of their investments in the US. So we're not the first Canadian. I'm not the first Canadian. I know you and I with our business thesis that, we're helping Canadians and Americans invest in these multifamily assets. But there's a lot of other Canadians that are looking to the US and saying, geez, like that's a really good place to invest. So the Canadian pension fund has over 50% of their investments in the US. And so what he was saying was, and it panned out this way, is he said, at the end of the day, if this does apply, this not only affects real estate, but this affects the overall markets as well. So any of the equities there that are paying out in U.S. to Canadians, that this is going to impact them. So his whole thesis was just give it a little bit of time to breathe, because that other client that changed 5 times. But he says, I don't see it sticking. He thinks that there'll be a little bit of posturing from the Canadian government, and then they'll bend on that. And they did. So yeah, it was a really good play by Trump. If Trump's focusing on the American citizens, which that is his job, he played that out well. It was interesting because Biden administration had actually raised the the flag, not the white flag, but raised their hand and say, hey, listen, the digital sales tax that Canada implemented, that is not fair for our American companies. And so Canada's not the only one that introduced that in the past. There was a number of other European countries as well.
Right.
But yeah, Trump, he got it done in this, and so Canada removed that, and thus, it's good. He actually kept to his word. He's like, okay, we're going to remove this revenge tax for outside investment for Canadian investment coming in. And I'll tell you, that was massive. But that's just one of the items we're going to be talking about today, John. Yeah. But that was a big check mark. And it just goes to show you that at the end of the day, the U.S. wants outside investment. They want to make it happen, but they want to structure it so that this is making it a win-win deal. And in this case here, we're basically the road is paved ahead of us so that we can continue to focus on taking these assets down and having the Canadian investors invest into it. That's in a very efficient vehicle.
That's right. So, just for a little color for those, maybe you weren't aware of this, but the bill originally had a provision that would have basically charged a 5 to 20% tax on foreign investors investing in the US. It basically would be up to 20% withholding. And so that would have made it, the deals less attractive, right? I mean, that taxation would have a real impact on that investor's return. So, sort of like to my, analogy, almost like a nuclear bomb where, what you really need is a more sniper like targeted approach. And by that, I mean, one thing that is impacting America and something that I do worry about is that, for example, China is buying up a lot of our farmland. And so, is that a security issue, a national security issue? I think so. When it comes to food supplies, is there anything more important? I mean, if a country cannot adequately supply food, the whole system breaks down, right? And so, making some limits on that. There also have been some bad actors, money launderers. Maybe some of the Russian oligarchs or Saudi Arabia. Where the money's a little like, not clean, right? And they're coming in and buying, $100 million condos in Miami just to launder the money and hide it. And so they've done some things over the years where now you have to disclose where your money's coming from, anti-money laundering, anti-terrorism. And so I think building on that makes the most sense. And, ultimately, Trump, to your point, has to look out for the best interests of America. And that digital services tax would have been a massive drag on a lot of large companies. And so getting that removed, and now we're able to remove this revenge tax. So, effectively, we're back to where we've been. So, in other words, an investor investing in one of our deals because of our limited partner structure and the fact that Canadian investors actually investing in a Canadian company, you would not be subjected to dual taxation. We spent a lot of time crafting that with cross-border accountants and attorneys to ensure our structure will allow for that. So we're basically back to where we were a few months ago. So investors in our deals can invest with confidence, knowing that they'll only be taxed on their side of the border and still get those great returns we're promising. So to me, that was like the number one highlight. Like when I saw that come across, I called you immediately. I was like, Mark, great news, right?
Yeah.
But what was cool, there's some other things along the way that are added. And I would say that a lot of these things we're going to talk through are really going to be more specifically geared towards that US investor. But the benefit of these will be more capital coming into this space, right? Because ultimately, if you make it easier and more attractive to invest in real estate, more people will do it, particularly that institutional money. And it's that rising tide lifts all boats. The more money coming into this space, we're going to see some really great appreciation over the coming years. So it really actually makes all of our deals even stronger because of some of these things that are buried in this bill that, once again, if you're listening to this and you're Canadian, you may not get the direct benefit in terms of a tax break, but what you're going to see is a flood of new investment coming into this space that'll lift up the values of all these assets. So it's really exciting.
Yeah, 100%. And there are billions and billions of dollars. I saw an article recently that had come through that is the amount of dry powder. You have Blackstone, you have Brookfield. They have billions and billions and billions sitting on the sidelines right now. And they are very close to redeploying that capital right now. And so when that happens, that means that these assets that we're going after, there's going to be more and more demand. So these assets that we're acquiring right now, I think it's one of the best. John, I really I think in a couple of years, 2 to 3 years down the road, we're going to be looking back in today and say, oh my goodness, like there was quite a dip there. And if you bought in that dip, you are doing exceptionally well because, at the end of the day, the case for multifamily has never been stronger, right?
Yeah.
The renter demand. I mean, renters are growing in this country. I mean, whether you like it or not, it's harder and harder to own a house. And
That's right.
so that demographic that is growing. You have population growth in the areas that we're buying. There's affordable, people are moving there, employment is moving there, and then now with the whole made in America, these employment large employers, they're moving into these areas that we're buying that are affordable because they can afford to pay their employees less than if they had their their manufacturing plant in San Francisco or New York, right?
Yeah, that's right.
And they're landlord friendly. So yes, there's lots of dry powder, but John, you nailed it. Is that these rules that we're going to be going through, these recent changes in tax code, is just going to make the existing investors, any new investors, that much more excited to come in. And so I'm going to start off with this 100% bonus depreciation. So a number of years ago, I believe it was Trump that originally
That's
offered
right. Yeah,
introduced bonus depreciation, right? So you go and you do a large capex spend in year one, you can actually take 100%. This is something that Trump had introduced a number of years ago. 100% of that, and use that as a tax write off to lower your taxable income. Well, every year that went by, that 100% it shrunk, and so I think it's down to like 40% now.
that's right.
Uh,
Yeah, 40% for last year, so 20% for next year. But yes, that's right,
got it.
40%. Hmm.
And so now Trump comes in and say, wait a second, we're going back to 100%, which means that there's that much more tax write-offs, which means there's that much more incentives for real estate investors to come in to lower your taxable income. It means that real estate investors can keep more money in their pocket. And this is a massive, massive deal because it's not only year one, this is something that is more of a longer term approach that he's basically restarting the engine when it comes down to this bonus depreciation, which is a massive deal and something that, quite frankly, John, we weren't expecting.
No. No, I remember we did an episode a number of months ago, and that was one thing I said. I'm hoping that with Trump back in office, he brings it back, and so it was really good to see. I mean, this will effectively create over $200 billion in tax breaks for these deals, and what that'll look like is that money is just going to get invested back into these deals, right? And so, more demand for product, more investments coming in means the values of these buildings are going to go up with that competition. So it's huge. And so beyond that, right, that capex, but it's also about separating out the personal property from the real property. So the real property is the land and the building itself. But in commercial real estate in the United States, things like your countertops, your cabinets, your appliances are considered personal property. So that's factored in this, sort of cost segregation, bonus depreciation. So it's just made it very attractive to invest in. And once again, that's going to drive more investment and a property appreciation over time. At the end of the day, Trump started, I mean, he's a real estate guy, right? So he
Yeah.
understands the importance of real estate. And, real estate is the biggest asset class, in the world, right? So providing these incentives will be huge. The next one are what's called a 1031 like kind exchange. And that's where a U.S. investor, when they exit an investment, there's a period of time and you have to work with some third party intermediaries. I won't get into all the weeds there since most of our listeners are Canadian, but it's a way for an investor to take gains from one investment. And if they place it in another like kind investment within a 90-day period of time, following a few other timelines and rules, they basically are kicking the can down the road on that capital gain. So a savvy investor can 1031 into deal and deal into the next deal to the next deal over a period of maybe say 15, 20 years. And then when they finally exit, that's when that capital gains kicks in. And so once again, that's just going to spur more investment into these deals because of that ability to offset those capital gains. Basically, the program was left intact, untouched. There was some thoughts of potentially getting rid of it. So no changes to timeline or scope. So once again, it's just going to spur more and more investment into this type of real estate.
Yeah, well said, John. And this is something, if you're a Canadian listening right now, um, I tried real hard. I went back and forth with our cross border accountant if Canadians can get access to this 1031 exchange, and it is not something that the CRA or the Canadian tax code is permitting. And so Americans really do get a major advantage when it comes down to taxes, but for Canadians, that's something that doesn't apply. Now, that going back to the original thing that we had mentioned, all these things that didn't change and things that were reintroduced, this bonus depreciation, this is just going to mean that there's going to be more demand because the deals just keep on getting better. So the 1031 exchange is not something that's permissible for Canadian investors. That being said, all of our American investors get access to that.
That's right. There was another piece in there about the qualified business income deduction for pass-through entities. So that number is now 20%. So just to put it in simple numbers, a million in income, partnerships will now save approximately 40 to 50,000 in taxes on that million in income. And so that's just putting more money back in savings back into our deals that could be distributed out to our investors. So just another opportunity that'll help, spur more investment, but even help our investors on their returns of these deals. And then the last piece were opportunity zones, which we'll spend very little time on because we do not do opportunity zones at Faris Capital Partners. It's not to say we never will, but basically we've identified certain areas of, say, a major city. So I think about Nashville as a great example. We're right outside of downtown Nashville. There's a river, and along that river, just on the other side of downtown Nashville, it's just this like industrial area. And there's like recycling plants and all kinds of stuff. And some of them are shut down. So that's an opportunity zone. So basically, there's major tax incentives for the developers. But opportunity zones are effectively syndications, just with a 10-year hold period, and investors in those opportunity zones get some incredible tax benefits. So that program was made permanent and expanded. Once again, not going to really impact us at Faris Capital Partners or investors, but will just spur more investment and more focus on this style of investing. So it's a good piece of good news, but not necessarily going to impact us or any of our clients or customers,
Yeah.
but worth mentioning.
Yeah, for sure. So really, I mean, the biggest win here of the talk, we've mentioned it now a number of times, is the revenge tax is removed. So that's wonderful for Canadians. So Canadians can invest in a very tax efficient structure with us. That's how we structure these deals. And then for Americans, it only got better
Yeah.
from this tax code. And John, you said it earlier, and it just makes sense. Trump is a real estate guy. And bottom line is he wants to make sure that real estate investors are getting properly looked after.
Yep.
And in this case here, in our approach is that we are doing a very good thing for the community in providing safe, clean, providing a culture of a great place to live. And so we are providing something for the community and providing housing for the working class. And so these, we'll say these changes, or these, some of them lack of changes, but then the changes for the greater good is a very, very positive thing. And it just, you had mentioned as well, is just boost the overall confidence of existing investors, and the amount of capital that is sitting on the sidelines is primed to come back in, and we are buying at a very, very prime opportunity in today's market.
That's right. So just kind of to recap, at Ferris Capital Partners, we're already prepared. So our structure is already a pass-through structure for U.S. investors who invest in our deals. We always do a cost segregation study the second we close. So we have those numbers. So that bonus depreciation, that'll just be on your K1. No need for you to do anything. And by the way, Mark, I mean, our Canadian investors do get some of this benefit because there is some depreciation write-off. And so with the T5013, you'll have your income, but you also show, your percentage of the capex that your dollars went towards. Those bonus depreciation models I mentioned, and we're focusing on markets that are likely to benefit from capital inflows. So the Sunbelt markets, the markets that are high growth. You touched on it, right? These manufacturing concerns are moving out of these higher tax states down to the Sun Belt. So a lot of migration from large companies into Florida, Georgia, Texas, the Carolinas. And so we're already well positioned there from where a lot of these investment dollars will flow. But bottom line is we'll just continue to track progress, right? We keep our ear to the ground. We watch what's happening in the government. We watch what's happening on a local level so we can make sure we're making the most educated decisions and looking out for our investors' best interests.
Yeah, 100%. So, John, just quickly here before we wrap up, I want to quickly mention this 114 unit apartment opportunity that we have coming down the pipe. Now, when this airs, there's a chance that it's completely sold out, but definitely go to fulloutinvesting.com, and you can actually book a one-on-one call with John or myself, and find out a little bit more about who we are, the investment, but definitely ask about our Atlanta opportunity. And again, it might be sold out by the time you listen to this, but moving forward, you want to make sure to get on our list so that you are first to find out about our upcoming investments. And by doing so, then you get to see these deals and potentially come in and partner with us and get access to these phenomenal value add apartment deals moving forward. And this most opportune time, I think it really is a phenomenal time in history to be buying real estate, especially multifamily. So thanks for listening, everyone. If you enjoyed this show, please share and subscribe to the channel, where we are building a community for high net worth investors to invest into real estate and do it completely passively moving forward. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.